Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Matt Mondoux, and Dan Seder. Quick episode today. We want to have a quick chat through an update on sentiment, some market rotation, and just some overall observations based upon those two things and some of the market action we've seen in recent weeks. Hard to believe that we're almost 2 months through 2025. I mean, it's so cliche to say the time is flying, but especially first part of the year when you're wrapped up in, company results that are kind of showcasing last year and all that stuff. We have talked about sentiment at various points in the past. We talked about it more recently, and basically, if you'll recall, sentiment indicators in financial markets are some of the best contrarian indicators that exist, meaning that when sentiment is incredibly optimistic from retail investors, it's usually or historically has been a good time to sell. And when sentiment is incredibly negative from retail investors, historically, it's been a very good time to buy.
Real quick, just generally as it pertains to what you just said, why sentiment matters at extremes. Let's just talk through that. If everybody's bullish, okay, so if let's say the sentiment across the investor community is extraordinarily greedy, they're very, very bullish, that means everybody has already bought. So how many more buyers are there out there to buy again? Right. None. All the buyers have been exhausted. The same thing with sellers. If sentiment is very bearish or fearful, well, how many more people are out there to sell? None. Everybody's already sold. And so the market can't go any lower. So that's why this is a really great contrarian indicator, because you're basically taking the opposite side of the masses, right? And the masses, when they're super, super bullish, there's nobody else to be bullish. So the natural path of least resistance is down. And that's what being contrarian on a sentiment indicator means.
Right. Yeah. So AAII, American Association for Individual Investors, puts out a sentiment survey. CNN runs this fear and greed index that I think is incredibly user-friendly. You can pull this up on any web browser yourselves right now. But both of them basically tell the same story, and they line up with exactly what Dan just walked through with regards to when things look greedy, when things look fearful. And I guess more specifically right now, right, like what you see from the CNN Fear and Greed Index is that there's extreme fear in the market, right? So what does that tell you guys?
I think it's really interesting at this moment in time because we're near all-time highs. Generally speaking, we see these readings after a market correction, 10, 15%. And here we are near all-time highs having these readings. I think it's incredibly interesting. I think it's going to say, don't be surprised, investors, if there's volatility. People are on the fence on how to feel about this market. Volatility would be expected. But what we're certainly not, in my opinion, certainly not foretelling is we're at the start of a severe market downtrend. Market downtrends generally do not start when people are this pessimistic.
Yeah, and one question I have kind of as it relates to this, just because you saying that from a historical perspective, usually when you see extreme fear, it's not at market tops. I wonder if some of this is just based on the fact that if you look at Magnificent Seven performance year to date, it's not very good, right? Maybe the fact that some of the largest companies in the S&P are sputtering more or less, and the returns in the market this year, at least year to date, are driven by some of the boring stuff, consumer staples, healthcare. I wonder if that
defensive sectors, yeah.
Yeah, I wonder if some of that has an influence on
of
some
course
of these
it
readings,
does.
right?
Of course it does. How many people have you talked to in the last 3 years or longer that have been out there promoting their position in Philip Morris or in consumer staples or utilities, right? They're out there talking about their position in NVIDIA. They're talking about their position in Apple. They're talking about all the sexy Mag 7 stocks. And this is what I would consider to be the lifeblood of a bull market, which is sector rotation.
Right.
The rotation from the tech or growthy types away from tech or growthy into some of the more stable, conservative, consistent type performers.
Yeah. Well, and I mean, we saw this at points in the past. I think it was specifically in the first quarter and then again in the fourth quarter where you saw more of this broadening out of returns. And again, this is a concept we've touched on numerous times in this forum. But if you can see something like the S&P 500 equal weighted index start to outperform the S&P 500 cap weighted index, that starts to indicate that returns in the market are more broad-based. They're not just dominated by, the Magnificent Seven or a handful of the largest companies in the United States. We have started to see that again this year. We started to see at the very beginning of this year, it took a pullback in terms of being more concentrated. But then over the last 5 days, the S&P 500 equal weighted index is more or less flat, while the S&P 500 cap weighted index is meaningfully down. Yeah. So regardless of when you're listening to this, that concept holds true. And that's another kind of lifeblood of a bull market: healthy participation across sectors, no concentration of returns, and seeing sectors that may or may not be a high weighting in a cap weighted index like the S&P 500, again, staples, utilities, whatever it may be. Those should be taken as really encouraging signs. And when they happen to line up at a time when these sentiment indicators are screaming extreme fear, honestly, it makes me pretty optimistic.
And keep in mind the CNN Fear Greed Index. This is an oscillator. So what that means is it's not a chart like a stock chart that can go up for some undetermined or indefinite period of time, undetermined amount or indefinite period of time. This is an oscillator. The most it could ever be is 100, which means every single person is greedy. The least it could be is 0, which means everyone's bullish or fearful. And so it's rotating between 100 and 0. And there are these critical thresholds that the index will show that when it breaks 75, that's considered extreme greed. When it breaks below 25, that's extreme fear. And if we use just those simple thresholds as market timers, not that we're timing from I'm not saying this is actionable, but for helping investors understand perspective, if you cross below 25, like we did last August 5th, and invested at that point until this sentiment indicator crossed above 75, which it did in mid-October, you would have seen a 15% increase in your position over that period of time. Now, I'm not encouraging anyone, let alone it's not how we operate the portfolio, to go out and time trades based on the Fear Greed Index, but this is one arrow in the quiver, one that should be used very often and very seriously.
Well, and it's also just like, even though we're not recommending wholesale changes in a tactical manner, I mean, I think about some of the stuff we discuss in the investment committee on an almost weekly basis in terms of risk management, understanding when the right time to pare back some gains in a position that has doubled is, right? I mean, like, those aren't wholesale changes, but this is information that can be incredibly helpful from a risk management perspective, as long as you use it accordingly, right?
Yeah, I mean, like Warren Buffett is famous for saying, be fearful when others are greedy and be greedy when others are fearful. So, right. I mean, take with that with what you will, in the context of this current market, but that would suggest that at the least, you shouldn't be fearful.
I only wish that they had indicators like this on individual stocks. Now, I know there's some technical indicators that you could potentially relate them to, but it's interesting when you see the market as a whole, the market of individuals as a whole, vote on how they feel about the stock market. It would be nice to see if all investors were bullish on NVIDIA, and then you might have some indication that NVIDIA is reaching a short-term top.
Yeah.
And the opposite. Sentiment is just one tool in the toolbox, right? So most of our discussion today has been on sentiment. We're not saying that it's the only way that you evaluate the markets as a whole. It's just one tool. So just make sure that you have plenty of tools in the toolbox and that you use sentiment as one piece.
Yeah, I think that's well said. Hope you guys enjoyed another episode of Blue Chip Now. Thanks for tuning in, and we will speak with you next time.